Do you know why most altcoins never recover the way you expect? Even after the market comes back, even after Bitcoin hits new highs, even after the headlines turn bullish again. If you've ever stared at your portfolio thinking, how is Bitcoin near the top, but my altcoins are still down 70, 80, 90%, this video is for you. Because the truth is uncomfortable, and almost no one in crypto wants to say it out loud. Altcoins don't fail randomly. They fail structurally, psychologically, systemically. And once you see it, you'll never look at a crypto cycle the same way again. Let me show you what's really happening. Here's the first thing you need to understand. 1. Altcoins are not designed to recover. They're designed to launch. This is the hardest pill to swallow. Most people believe altcoins behave like stocks. They assume if it went up once, it can go up again. But crypto doesn't work like equities, and altcoins especially don't. Most altcoins are engineered for one primary moment, the launch phase. That's when the narrative is clean, the story is simple, the promises are infinite. New tech, revolutionary blockchain, game-changing utility, next Ethereum, next Solana, next Bitcoin. But after the launch hype fades, the incentives shift. Token emissions begin, vesting schedules unlock, early investors slowly exit, founders start diversifying for safety, marketing budgets dry up, roadmaps stretch, deadlines move, and the token itself, it becomes inflationary by design. This isn't a conspiracy, it's math. Most altcoins print new tokens every single day. Validators get paid, stakers get rewards, teams get allocations, treasuries unlock. So while you're waiting for price to recover, supply is quietly increasing. Imagine trying to fill a bucket with a hole in the bottom. That's most altcoins. Bitcoin doesn't have this problem. Its supply is capped, predictable, and every 4 years, new issuance drops. Altcoins usually do the opposite. They start restrictive, then loosen over time. So when people say, just wait for the next cycle, they ignore one brutal truth. The altcoin you're holding today is not the same asset it was during its peak. Different supply, different incentives, different market. And price remembers that. Now let's go deeper. 2. Altcoins depend on attention, and attention never comes back the same way. Crypto is a narrative-driven market, always has been. Prices don't move first, stories do. Think back to the last cycle. NFTs, metaverse, Layer 2s, DeFi summer, GameFi, AI tokens, Web3, everything. At the peak, it felt obvious. Everyone was talking about the same things: Twitter, YouTube, Discord, Telegram. But here's the part nobody wants to admit. Once a narrative dies, it almost never resurrects in the same form. Why? Because attention is a one-way street. The market gets bored. New traders arrive, fresh capital wants fresh stories. They don't want to hear about a protocol from 3 years ago that already failed to deliver. They want the next thing. That's why you see something strange every cycle. Bitcoin recovers, Ethereum recovers, a handful of large caps recover, but most altcoins, they stay flat, or drift lower, or pump briefly, then fade again. Not because they're bad tech, but because the story expired. Think about it. When was the last time you got excited about a project you already lost money on? Exactly. Markets remember emotional pain, and they avoid it. So when a new cycle begins, capital doesn't flow back to old narratives. It rotates forward. That's why bag holder coins are a real thing. Once an asset becomes associated with regret, it carries invisible resistance forever. Every pump hits sellers. Every bounce meets exit liquidity. Not because people hate the project, but because they want out. And that creates a ceiling that's almost impossible to break. Now let's make this even more real. 3. Liquidity concentrates. It doesn't spread evenly. This is where most retail investors get completely misled. They hear, Altseason is coming, and they imagine all altcoins rising together. That almost never happens. What actually happens is concentration. Liquidity flows to a small number of winners and ignores the rest. Why? Because capital is lazy. It wants the safest, risk-adjusted bet. In early cycles, liquidity was forced to spread out. There weren't many options. Today, though, there are tens of thousands of tokens, so money becomes selective. It goes to assets with strong brand recognition, high trading volume, clear narratives, institutional access, deep liquidity, simple stories. That's why Bitcoin dominates. That's why Ethereum survives. That's why a handful of layer 1s and infrastructure plays keep coming back. But most altcoins don't have that gravity. Once volume dries up, market makers leave, spreads widen, slippage increases, and suddenly even small sell orders crash price. At that point, recovery isn't about fundamentals, it's about liquidity. And liquidity doesn't care about your conviction. It goes where it's easiest to deploy, where exits are clean, where upside feels obvious. That's why new altcoins often outperform old ones. Not because they're better, but because they're empty. No bag holders, no trapped supply, no emotional resistance. Fresh chart, fresh story. And the market loves that. Now let's talk about something people really don't want to hear. 5. Teams move on long before investors do. This is uncomfortable, but it's real. Most crypto teams are not evil, they're human. They launch a project, it pumps, they work relentlessly. Then the market crashes. Funding dries up, community turns hostile, every delay becomes a scandal, every update gets ignored. Meanwhile, new opportunities appear. New chains, new narratives, new grants, new incentives. So what happens? Quietly, teams shift focus. Not always publicly, not always maliciously, but energy moves. You see fewer updates, less engagement, slower development, vaguer roadmaps. And eventually, the project enters maintenance mode. Still alive, still posting, still building something, but no longer fighting for dominance. And the market senses that. Price reflects effort, momentum reflects belief. Once belief fades internally, external belief follows. That's why some altcoins feel dead even when they're active. The spark is gone, and without that spark, no amount of marketing can revive price sustainably. Here's another layer most people miss. 5. Retail expectations are anchored to fantasy prices. This one hurts. Most altcoin holders anchor their expectations to all-time highs. They say things like, if it just gets back to where it was, I'll sell when it breaks ATH. It only needs a 5x to recover. But they forget one thing. Market cap matters. A coin that went from $100 million to $10 billion didn't do that because it deserved it. It did it because liquidity was reckless, narratives were euphoric, and risk management was non-existent. Those conditions don't repeat easily. So when you expect the same price again, you're expecting the same insanity. That's not how cycles mature. As crypto grows, returns compress. The easy multipliers disappear. That means many altcoins will never justify their old valuations again, not because they failed, but because the market moved on. And yet, retail refuses to accept this. So they hold, they wait, they average down, they tell themselves stories. Meanwhile, opportunity cost quietly eats them alive. Let's pause here. If this feels personal, that's good, because every experienced crypto investor has lived this at least once, holding an altcoin long after the thesis broke, waiting for a recovery that never came, watching Bitcoin move while their portfolio stayed flat. This is how you learn. Now let's zoom out. What does this mean for you going forward? Here's the key takeaway. Altcoins are cycles within cycles. They are temporary vehicles, not permanent stores of value. That doesn't mean you can't make money. It means you need to change how you think. You don't marry altcoins, you date them. You ride narratives, you manage risk, you rotate. The biggest mistake retail makes is assuming loyalty will be rewarded. Markets don't reward loyalty, they reward timing. So how do smart investors actually play this? They ask different questions. Instead of, will this recover? They ask, does this still matter? Instead of, is the tech good? They ask, is attention returning? Instead of, how high can this go? They ask, where does liquidity want to go next? Because price doesn't move on hope, it moves on demand. Now, let me be clear. This doesn't mean altcoins are dead, it means the bar is higher. The next winners won't look like the last ones. The next narratives won't reward old bags. And the next cycle will punish complacency even harder. Bitcoin taught the market discipline. Ethereum taught the market utility, the next phase will teach the market selectivity, and that's where most people will struggle. Let's bring this home. If you're holding altcoins right now, ask yourself, why am I holding this? Is it because the thesis is still alive, or because selling would hurt emotionally? Am I betting on recovery or positioning for opportunity? Those are very different strategies, and confusing them is how portfolios stagnate. Here's the real reason altcoins don't recover like you expect. Not because crypto is rigged, not because whales hate retail, not because this time is different, but because markets evolve, narratives expire, liquidity concentrates, and emotions anchor people to the past. Once you see that, you stop waiting, you start positioning, and that's when crypto finally makes sense. If this helped you think differently, you already know what to do. Stay curious, stay flexible, and don't let old stories trap new decisions. I'll see you in the